From the financial centers of the world, this is Bloomberg Markets with Alix Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, November 9th. Here are the top market stories that we're following for you at this hour. All together now, Fed Chair Jay Powell, ECB head Christine Lagarde comment on the economy later today as financial conditions loosen and bond yields retreat from 16-year highs. We're going to see if everyone is still on the same page. And prescription for success, AstraZeneca boosting its pipeline into the booming anti-obesity market and says its pill could be much cheaper than its rivals. We're going to talk to the company's CFO. And the winds turn for Vestas. Wind turbine maker raises its outlook after turning a slim profit. We see if the worst is finally over with Vestas president and CEO Henrik Andersen. From New York, I'm Alix Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Those are the headlines, but really, we're all waiting on what's happening with the S&P. Flat, but can it eke out that ninth day of gains?
Absolutely, but this is part of the easing of financial conditions, isn't it, that we've seen? And that kind of speaks to your first headline. Equity markets have had a good run. Bond markets have had a good run. Now we get to the crunch point. We're going to hear from Powell. We're going to hear from Lagarde. What are they going to tell us? Are they going to push back on this easing? Because for a long time, well, not for a long time, for a little while, they talked about the fact that markets were doing the work for them.
That's right.
Is that still the case? I
mean, if it goes one way, doesn't it go the other way? So if bond yields at 16-year highs, tighten financial conditions, if they're down from that by a good 50 basis points, doesn't that also do the otherwise? Also, let's keep in mind, the last 9 days, the S&P is up. It's up 6.5%. Yep. Like, it's not, you know, we're not like catapulting higher here.
That's not nothing. No, but it's not nothing. That's a decent move. Yeah. And what's driven it, I think, is important because there's all kinds of countercurrents in these markets right now. But the market definitely feels like it's pricing out a recession, certainly over in the United States. Basically, is everybody on the same page? Is the bond market? Is Powell? Is Lagarde? Are they all on the same page? Joining us to discuss this. Here's Simon White, standing next to me. Mike McKee, over in the United States. Simon, I'm going to start with you. Bond market, Powell, Lagarde. Are they of one mind right now? Where do the cracks lie?
I think it's going to be really difficult because at this point in the cycle, we know that inflation is still kind of rolling over, but we have like cracks in growth. Yep. Inflation tends to lag growth, right? Yep. So if inflation is going to pick up, which I think it will kind of next year, we'll get a re-acceleration. It's going to happen after you get the growth stuff. So right now, you're going to have this situation where we're going to get slightly worse economic growth data coming through. And it's going to be really difficult for the market not to try and price in cuts, which is why
it really has, hasn't it?
Well, yeah, but even more cuts than what we've seen. And that's kind of why, you know, that central bankers, they need to keep, certainly the Fed, need to keep that kind of dream of that one more hike alive.
Right.
Because as long as they're saying, look, we might still hike, it's going to be very difficult for the market to really kind of like get ahead of itself and start pricing lots of cuts. So we're in that very hard environment, but it'll be hard for them to keep that hike alive if the data starts to deteriorate.
Well, okay. Do we get any clarity on that today when we hear Lagarde and Powell speak? Like, will we hear them sort of push against the cut mentality and they're all on the happy same page again?
Taking them one at a time, I don't think you'll get much from Christine Lagarde. She's speaking at the inauguration of basically a museum in Brussels.
Excellent point.
I don't think that it's the opportunity she's looking for to go in depth on monetary policy, like yesterday with Jay Powell and his history of the Research and Statistics Division of the Federal Reserve. Today, Powell could choose to do that. Certainly, the markets have not been listening to him. He said, we're not thinking about cuts, we're not talking about cuts, and the market's priced in more cuts and sooner. So he could push back, but the topic of his appearance is global challenges for monetary policy, and he is appearing with the central bank governor of Israel, Amir Yaron, and there's going to be a guy with something interesting to say about his economy, and Gita Gopinath from the IMF. So it may be more international than it is local. But the bottom line for both Lagarde and for Powell, if they want to talk about it, is there's still many weeks from the next meetings. And as Simon said, a lot of data coming out. Yeah, but and so we got to wait and see how that affects their thinking.
The problem is, though, that we find ourselves in a situation, as we have before, Mike, where if the market goes too far, the central bank's really going to have to push back quite hard in order to bring the market maybe back to where it wants it to be. So how much longer can they let this easing process unfold? How much longer can we see bond yields dropping before the Fed has to say something? How much longer can we see financial conditions easing before the Fed has to say something? Because if it goes too far, then they're going to have to maybe cause a problem for the markets, and we get a lot of volatility. So is this the moment maybe just to kind of nip it in the bud a little bit?
Well, I think that, yeah, and the reason being is we get the inflation data next week, and why not wait for that?
Yep.
And it gives you a much better idea of where you are. And that might influence the markets more than anything that Jay Powell might say today, because it'll be the next thing that people look at. We also get retail sales and PPI here in the U.S., so a lot of data next week that could move the markets, so the Fed can wait and see what's going on. They can probably wait a little bit longer, too. The futures pricing changes constantly, and it's never particularly accurate until about a week to 10 days before the Fed meets. So they definitely have some time.
Okay, can I just say the elephant in the closet here is that maybe the Fed and the ECB matter less. So we were talking about this on the call, and then also Mohamed Al-Arian was talking about this earlier, and he wrote in a piece that in 2024, with the central bank having most likely reached peak rates, the driver of yields will shift away from monetary policy and toward government bond issuance and economic developments. And you can see this, it seems like, very clearly in the 10-year yield. I mean, are we seeing a place, Simon, where central bank policy is going to matter less for the long end, and it's going to be fiscal policy?
I mean, it's already happening. That's kind of where we are, right? You cannot have a government running such massive fiscal deficits. Even if it doesn't want to interfere with monetary policy, it will. So we're kind of already there. And that's, a situation that's basically happened over the last 15, 20 years. It's been gradually happening, and then it kind of accelerated in the pandemic. You just, as I say, you can't have a government running 8.5% fiscal deficits and that not interfere with monetary policy. So I think, it's going to be a challenge going forward, but it's kind of like the end game, right? When you have monetary policy kind of losing traction, which is basically what happened. I mean, they've been trying to loosen policy every response to a crisis over the last 30 years. They've had to progressively loosen more and more. It ended up the great financial crisis. We had QE, and then we ran out of road. And unfortunately, the government needed to step in and, combine with monetary policy. And the downside of that is that you're running massive fiscal deficits, and you end up with what they call fiscal dominance.
Is that a problem here in Europe as well, though? It's definitely a problem over in the United States, but to what extent is that manifesting itself for the ECB?
Yeah, I mean, I think they're all going down the same track, but at different speeds.
Right.
I'd say the US is obviously ahead of the game because it's been running much larger fiscal deficits. But look, there was a real kind of sea change about over the last few years, especially what people expect from their governments. So I've called this the fiscal put, where we're used to the Fed put or the central banker put. After the pandemic, there's a huge expectation what people now expect from their governments. That's why they're running much larger fiscal deficits, even outside of recessions. So I think it's happening in Europe, in the UK, it's happening in Japan, obviously, and it's already happening in the US. I think this is a sea change. We're now in a very different environment. So comments from Ken Griffin earlier about how this is an inflationary world, these all relate back to the same thing. This is a very different regime from what we were used to before.
Yeah, so Mike, I guess then that begs the question, the term premium part, is it going to be more fiscal related then? And you were talking to Kashkari about that, and he was basically like, I have no idea.
The dark matter. Yeah,
clearly we're talking about it, but we don't know it.
It is, as Neil was explaining, it's the residual. It's everything you can't explain goes into this term premium. And there's a logical reason to think that maybe that there is an additional price you have to pay for the uncertainty of the time you're holding the asset. But there's no way to really measure that. And so they look at it as the term premium. But I think Simon's right that we're going to switch to the fiscal, not necessarily for the markets, because for the markets, the idea of cutting rates next year is going to be paramount, both in the U.S., the U.K., and the ECB. But you've got elections coming up in the U.S. next year, and elections in 2025, if not sooner, in the U.K., and there is already a lot of pressure on those governments to cut spending or cut their deficits. And that's going to become a big issue for the American people and later on for the British people, because the politicians are all going to be talking about it. And it's going to be in the TV commercials and everything like that. So fiscal is going to become much more important than it has been up to now.
Yeah, but I'll believe kind of cuts when we all see it, I guess.
Well, I'm not saying they're going to do anything about it.
Right, but they're going to talk about it, and that may move some markets. All right, guys, thanks a lot. Simon White and Michael McKee, we appreciate it. Thank you for joining us. So coming up, More insight into that question of the day. Are Powell, Lagarde, and the bond market still on the same page? We're going to talk to Sonali Peer, portfolio manager for high yield and multi-sector credit over at PIMCO. And we were just talking about it. Let's listen to Citadel founder Ken Griffin at the Bloomberg New Economy Forum in Singapore as he sounded that alarm on U.S. government spending.
There's no doubt that a big part of the move in the 10-year this year has been driven by the realization we're in a full growth economy, full employment economy, and we're going to run almost a $2 trillion deficit this year. Like, in some sense, you're supposed to save in this moment in time for the rainy day, and yet we're spending at the government level like a drunken sailor.
I don't see how we can bring back inflation at target. Everybody focuses very much on the big drop, but the truth of the matter is that inflation is well above target rates across the globe, and is much stickier than we think. So I don't see how you can bring back inflation without creating an economic downturn.
Now, Sergio Armati, UBS Group CEO, talking about the challenges of sticky inflation at the Bloomberg New Economy Forum in Singapore earlier. Which brings us back to the question of the day. Are Powell, Lagarde, and the bond market all still on the same page? Just last week, central bankers were talking about the bond market, helping them do their job for them. We've seen now yields move lower on the 10-year by 50 basis points. So does the reverse hold true too? Sonali Peer, portfolio manager for high yield and multi-sector credit at PIMCO, joins us now. Sonali, what do you think? Are central bankers in the bond market on the same page?
Yeah, I think the initial move wider in rates certainly was the market helping the Fed do its job. But I think at this point, given the rising risks with geopolitical risk, with the broader economy, the Fed has reemphasized the data dependence. I think they're going to continue to buy time as they look through the data and try to sift out what their next move may be.
Sonali, what we are seeing at the moment is something of a growth slowdown. Everybody's talking about a soft landing. I'm assuming that a soft landing basically means getting to 2% without a significant recession. How likely do you think that is at the moment?
Yeah, it's a great question because, we have not seen that be successful in the past, but certainly it is where the market has coalesced on a go-forward basis to date. I think it really leads to, is part of the reason why we've seen such significant dispersion, for example, in the credit markets. The haves and have-nots and really the high-quality portions performing very well, but a very skeptic eye towards the low-quality portions because it seems very difficult to avoid, while it may not be today a recession, but one over a longer-term horizon. And therefore, we're seeing more and more differentiation between credit quality, between industries, and even between regions.
So then that's happening, but it's not reflected in the overall index then to some extent. If, say, central bankers take somewhat of a back seat when it comes to long ends, and it's more fiscal, right, and then how governments manage their fiscal deficits, et cetera, what's going to happen to the high yield market? What's going to happen to the credit market in that kind of environment where the driver just becomes different?
Yeah, one thing that's also helping, markets like high yield is the fact that the asset class is actually shrinking, right? Year to date, we've had about 120 billion of rising stars, companies going from high yield to investment grade. And most of the issuance we've seen so far is targeted towards more of the refinancing. So the asset class is shrinking, which is what's helped yields, or spreads especially, stay more range bound relative to, say, history. When you look at kind of a go-forward basis, we are still concerned about companies that have low margins, low multiples, just have more cyclicality, less flexibility in that capital structure to grow into it. With respect to rates, that question remains, at this point, monetary policy effects have lagged, especially in credit markets and fixed income markets, because many have termed out their debt. Right, not in the corporate side as well as on the sovereign side. So they have not yet had to bear the full risk of the increase in interest expense just yet.
That is coming, though, isn't it? We've got a load of maturity walls next year.
Absolutely.
And the expectation is that we can get over those walls and this process can be managed. How ugly do you think it could be, though? If we are in a higher for longer environment, at some point, we are going to have to deal with the higher.
Yeah, that's true. And I know, in fact, starting fundamentals have been pretty decent as well, which is why we've seen, actually, again, going back to why there's been so much bifurcation in the market, high-quality companies are actually starting to the extent possible, even buy back some of their debt at a discount today, knowing that the total interest expense will go up when they need to refinance. So if they can lower that debt stock, they can kind of at least, work through that increase in interest expense in a more reasonable way. So, in fact, through 2025, we only have 9% of the high-yield bond and loan market coming due. I'm more concerned about the higher for longer in the loan market, where it's floating rate in nature, and they're already seeing that impact from monetary policy change.
Yeah, I was going to say, because I wonder then if looking at the credit market, high yield investment grade is the right market to be looking at. I was reading something today that private credit is obviously a risk that it's not transparent, right? So we don't actually know what the read-through is for higher for longer in that market. You mentioned leveraged loans. Like, is that where we need to be looking for the real read?
Yeah, I think on a go-forward basis, both of those asset classes, levered loan market as well as the private credit market, will have significant opportunities. But because of the fact that they've grown so much, and there will be more dislocation, and there will be a read-through perhaps to high yield, but at this point, high yield has been a higher quality asset class, and much of the size and the lower quality nature of credit is shifting to the levered loan market and private credit market, making them ripe for disruption and potential opportunity down the line.
Let's just talk about what a hard landing would look like. If we get a hard landing, Sonali, just walk me through what you think is going to happen in the markets you just described and how different it will be to the kind of base case we're thinking about at the moment.
Yeah, with the hard landing, we would also, though, have rates rally, right? So that part would be helpful for credit. Obviously, spreads would widen. It's a question of the magnitude and given the size of these markets have all grown dramatically as well, right? So, again, when I think about a hard landing, usually that would be met with outflows. So there's also the aspect of, which asset class in particular would outperform and be able to be more shielded from those outflows, right? So, for example, while the quality of the high yield market has gone up and the loan market has gone down, in terms of quality, the difference is that over 2/3 of the loan market is owned by CLOs, which are not marking to market other than the excess of the 7.5% triple Cs, right? So that's a bit stickier. And so when you think about kind of how it looks down the line, a hard landing, there will certainly be volatility and dislocations that, say, a multi-sector mandate could take advantage of, trying to call where it's tactically overshot and be kind of more aggressive in that scenario. But, I think it will be quite varied through the process of getting there. And I think, again, going back to kind of the core of how we look at credit, looking for ones where there's flexibility in the capital structure, where there's the ability to, what the exit strategy is, such that there can be a catalyst for downside protection.
Sonali, great to catch up. Really appreciate the time. Thank you very much indeed for joining us. Sonali Peer joining us from PIMCO. Still ahead, disappointment for ARM. Its first earnings report was a little soft. The chip designer issuing a slow sales forecast, pressured by that weak smartphone market. What happens next is critical. Details to follow. This is Bloomberg.
It is 7:22 on the West Coast. Want to get to the startup where we cover the top tech stories from the Bay Area and beyond. Silicon Valley starts its morning, and we'll start it here in New York with Bloomberg technology co-host Ed Ludlow. Ed, I'm looking at ARM.
Yeah.
Down 6% on the day, huge gap lower after numbers. What was the biggest surprise out of all that they said?
We'll also point out that they've almost wiped out the entire gain they've had since they listed in September. So don't want to put a downer on things, but it's not great.
Well, it's a royalty company in some respects, so I thought this was supposed to be good.
That's what's fascinating. So there's a discrepancy here. Mm-hmm. Everyone's worried about the outlook for the current period we've just entered. The way that ARM makes money is they license IP for chip design and how that chip interacts with software, and then they book royalties basically on every smartphone that's sold. So the street's looking at the third quarter outlook, and even though they beat in the quarter just gone, they're saying, oh, Well, that's not good. This is at odds with like Qualcomm, for example, who we also measure by smartphone volumes because their chips go into smartphones. The discrepancy is that their full year fiscal outlook's quite good, much better than when they guided on the IPO roadshow. So it looks like this might be short term, but yeah, down 6% is big.
Ed, how much AI is there in ARM?
So this is why you focus on how AI makes money, right? Licensing and then royalties. Licensing usually is spread out over time as deferred revenue, but when you sign a new agreement, there is an element of a sort of upfront payment from the company licensing the tech. There's a lack of evidence here because even though in the quarter gone, the licensing revenues topped estimates, there wasn't some huge jump. So for all the hype, we're looking between the lines, but we're not seeing any evidence that their doors being kicked down for some big designs around AI, be it on the sort of device side or bigger picture on the data center side.
Why?
Yeah, I don't know. You know, the one question that I'm going to ask Rene Haas when we have him on the show later on Bloomberg Technology, thank you, is, you know, when do we see it? Because the big story of the last quarter was ARM-based PC processors for a world where we're all doing AI on our PCs. That's kind of the new story from the end market perspective. I don't see it in the financials. So I guess it just hasn't arrived yet, Guy.
Okay, we'll kind of ARM, we'll put the AI somewhere in there. Ed, when does the cycle turn? And what will we need to see for that to happen? Because this feels very cyclical to a certain extent as to what we're watching with these numbers.
Yeah, again, we're reading between the lines that royalties revenue kind of missed estimates significantly for ARM. And there's one way of looking at it. If you focus purely on volumes and you're trying to work out the health of a smartphone market, well, that's not really fair because at the higher end of the smartphone market, there's a lot more tech packed into that device. So many more ARM cores go into a higher end smartphone, meaning they do well even if the volumes overall were shrinking. I guess what's freaking everyone out is the inconsistency of this whole earnings period. Right. Qualcomm told us the smartphone market was improving. The next week, ARM says it's not. And it's like,
well, and that's
why?
The thing. That's the thing, Guy. I feel like it's when you have a structural shift, you still have cyclical industry. Like you can have both at the same time, but pricing that as an investor can be quite difficult.
And that's the struggle that I think this whole thing is. You got the AI burst of enthusiasm, then there's a realization that there's actually quite a large amount of cyclicality that we need to work our way through as well. And as you say, trying to figure out how you put that into the stock, really difficult. Ed, great stuff. Thank you very much indeed. Licensing versus royalty, very important. Ed and Caroline coming up on Bloomberg Technology. That conversation in around 90 minutes' time, they're going to be joined by the ARM CEO. So we'll get some answers. Rene Haas is going to be joining them. We're going to talk about the pharmaceutical sector next. This is Bloomberg.
We're about an hour into the U.S. trading session. It's pretty unremarkable. We're now moving a little lower on the S&P, down 0.2%, so maybe snapping that potential 9-day winning streak for the S&P. Abigail's tracking the moves. Abby?
Yeah, and here is the potential 9-day winning streak, although we do have the small loss on the day. But you can see here, this is a real definition over the last couple of days of taking the stairs up, very small moves. So perhaps this consolidation can work out, but on the day, down ever so slightly, as Alix was talking about. So this one looks like right now it will be right down to the close. Now, of course, one thing that investors are really liking is the fact that more recently yields have come in after the whole yield curve had basically moved up toward 5%. We now have yields backing down. The 2-year yield pretty close, truthfully, to 5%. The 5-year yield and the 10-year yield basically hanging out. This is still on the level of support that we were talking about on Monday and last week. So it's not clear whether what the next big directional move is for yields. And then the 30-year yield kind of, between the 5, 10, and 30, we're looking at a more normalized yield curve. Now, if we take a look at the S&P 500, one reason, though, to think that the gains may not last, at least in the near term. So over the last year, there is a bit of an uptrend. You can see that represented by the fact that the 200-day moving average, or the long-term buyers, it is higher, and it's still sloping upward, although flattening. This rally is built on gaps. A lot of times, these gaps tend to fill. It would not be surprising to see if, in the near term, these gaps fill back down to at least the 200-day moving average. The more times the long-term average is tested, like that. It's not necessarily a great thing. We don't know. It's just something to watch. I would also say that those stairs up, that the positioning of those, there's something a little bit awkward. It suggests to me that there probably is some consolidation ahead. But over the last 2 weeks, it's interesting to see some of the winners, of course, technology, some of the big winners. But take a look at PepsiCo and Mondelez. These are these snack companies. They both put up big quarters, neither saying that some of the weight loss drugs from Novo Nordisk and Eli Lilly are really going to hurt their sales. Mondelez CEO in particular on Monday said it's maybe about 1% of the sales. But you can see that Novo Nordisk and Eli Lilly, well, they're up with the snack companies. It's going to be interesting to see who wins, the snacks or the snack anti-snacks.
Anti-snacks. That's great. I love that. There you go, an anti-snack ETF. I feel it coming. Thank you so much, Abigail. We appreciate it. Let's get more on Eli Lilly and the challenges in the obesity drug market. We're joined now by Sam Pizzelli, Director of Research for Bloomberg Intelligence. Sam, what did you make of Eli Lilly, the announcement from the FDA yesterday?
The approval was, Alex, expected at the end of the day. I mean, this product's been on the market in the same form for diabetes for several years. So I'm not surprised. What was interesting was the pricing, of course, which is, I'm sure, what you're interested in, too. What we have to be careful with, though, is when you see these comments about we're going to price it at this and that, that's the list price. What happens underneath in terms of rebates, all that they give is what really matters.
It's like machinery orders.
It's the same kind of thing. So I would expect, and that was interesting because you thought, oh, they're coming at 20% discount, but Novo Nordisk is up also yesterday, or what, at least unchanged.
Yeah.
So the problem is, the issue is, what is the net price? I mean, everybody expects the net price to be pretty much similar.
Sam, how long will these companies have pricing power for?
Oh, I think pharma companies with these massive drugs genuinely lose pricing power. I think, we estimate that the rebate, the discount on Wegovy is already at around 55%. Now with these two drugs approved for obesity, the insurance companies and the payers will pitch them against each other and say, look, I want something, I want another 5%. They tend to keep going in terms of rebates. But remember, the cheaper it gets, the bigger the market, as long as they can manufacture.
Yeah.
Right. So volume versus price, et cetera. Yesterday, you were here, exact seat. We talked about AstraZeneca, who was reporting, and I was like, hey, are they going to get in the anti-obesity market? And you're like, nah, I think they're going to stick with oncology. And now do we know, not so much the case. So what are they doing that's different? Are we surprised?
Not really. I mean, they are in the cardiovascular space, and if they can get access to a drug, and they've been very upbeat about China and innovation in China along the way. So, it's a phase 1 drug. It's going to cost very little to try and figure out whether it works. They have had a diabetes drug that's got the same mechanism as Wegovy and Mounjaro from Lilly in history. It wasn't exactly the same molecule way of working, but they have had it. So they do have experience in this space. So I'm not massively surprised. But what I really like AstraZeneca for is the massive strides that they're making in oncology.
Yeah. All right. Well, we're going to talk to the CFO in a second, so stand by for that. Sam Pizzelli, Bloomberg Intelligence, thank you so very much. And coming up, AstraZeneca joining that weight loss drug race. We are going to be speaking with the CFO on the other side of this break. This is Bloomberg. This is Bloomberg Markets. You're looking at live pictures of the principal room. Coming up, David Risher, Lyft CEO, joins Bloomberg Technology today at 12 p.m. New York time. This is Bloomberg. All right, a quick check-in here on the markets. We're kind of going nowhere fast on a broad basis for the S&P. We were trying to eke out 9 days of gains. We may have given that up. And interestingly, over the last 9 days, it's been tech, consumer discretionary, and real estate. So kind of a mixed bag as to what really led the S&P higher. Yields also kind of not doing a lot yet. They're a little higher on the back end, but we do have that 30-year auction coming. And I should point out that the yield is below or sitting right at its 50-day moving average. So I wonder what the technicals will then look like after this kind of auction. Something else that we're looking at here are individual stocks like AstraZeneca. That stock in London up by over 2%. It had earnings and also said that it will be dipping its toe into the obesity drug market. The pharma giant is partnering now with Chinese biotech firm to make a pill that's said could cost less than the shots like Ozempic and Wegovy. So for more, we're joined now by AstraZeneca CFO Aradhana Sarin. Aradhana, thank you so much for joining us. A lot to get through, but the buzz is all about getting into that anti-obesity market. Give us a sense of timeline, give us a sense of pricing. You must have an idea, and that's why you said it could cost less than the shots.
So thanks for having me. Yes, a lot of excitement today. Obviously, we had a very strong quarter in the third quarter, but we also increased our guidance for the year with a few months to go, just given the strength we're seeing. So we increased both our EPS guidance as well as our total revenue guidance ex-COVID. There is a lot of excitement around the obesity space, as you know. The current products on the market are both injectable products that are available. And the license agreement that we did with Echogene is for an oral GLP-1. This is still early in development. It is in phase 1, and we expect to take it into phase 2 towards the end of next year. Because it's an oral molecule, it's obviously easier to manufacture, and we hope that over time, most of the market, as more oral products come into the market for obesity, the market will transition to more oral. When we did surveys and we talked to patient preference, more than 2/3 patients obviously would prefer an oral product. So we think there's a lot of potential in the obesity market.
Aradhana, good morning. It's Guy. What do you think is having the biggest effect on the stock today? You're up by 2% and a bit. You're pushing the FTSE 1 higher by around 14 points. But I'm wondering what you think that is. Is that your great numbers? And is that your guidance change? Or is it the fact that you're doing this in obesity? Because as you say, the buzz is there. I'm curious as to how you're kind of thinking about how you're going to drive share price forward at the moment, and to what extent this decision to get into this space was a kind of precursor to that.
So I can't really speculate on the stock price, but I think it's a combination of multiple factors. So clearly, it is the results and our performance that has not only been very strong in third quarter, and as I said, we raised guidance, but consistent over the last several quarters and last several years. I think secondly, it is the strength of our pipeline, broadly speaking. So if you think about it, we have about 120 phase 2 and phase 3 studies ongoing right now. We've had several positive trial readouts this year. We have several regulatory approvals, and we expect to continue that momentum into next year. So it's the ability really to replenish the pipeline and continue launching new drugs. And then thirdly, while the license that we did for this GLP-1 is interesting, it really builds on the cardiovascular, renal, metabolic area that we've actually been pioneers on for many decades. One of our largest products right now is Farxiga, which is an SGLT2, which has become really the fundamental treatment for patients with diabetes, with heart disease, with chronic kidney disease. So, and most of these diseases are actually linked. So, it's not just obesity, it's the ability to treat patients with comorbid conditions.
Absolutely. And obviously the oncology section of AstraZeneca, huge, with some solid results in different drugs. I'm just wondering, if we talk about the anti-obesity market, I mean, the numbers are really staggering. Other companies like in clothing or restaurants or the snack companies, they're coming out and already saying that they're going to be hurt on sales, or they're worried about it because of these kinds of drugs. Do you feel like we're a little bit too far down this road of what this actually means?
Yeah, I mean, again, I won't speculate on the impact on food companies and the like, but obesity is definitely a growing problem, and as wealth levels have risen both in emerging markets and in the developed world, it has become a greater problem. But I think we have to look at it not just obesity itself, but actually all the comorbidities that it causes, everything from sleep apnea to metabolic disease to diabetes and diabetic kidney disease. So I think it's the benefit of a drug like this, especially in combination with some of our other products, could be to actually, truly address the medical and the cardiometabolic conditions.
We're going to see a big meeting next week between President Biden and President Xi in San Francisco. We're all wondering ultimately how the world is going to change as we fragment, and that relationship increasingly looks like it's going to become difficult. You are caught up in this to a certain extent. We have an anti-corruption drive that is taking place in China. What impact is that having? How do you see that market developing? Do you think this is going to become the new normal? Are you rethinking your relationship with China going forward?
So we have a very strong presence in China. We are the leading pharmaceutical company in China. And, it's again based on the strength of the innovation and the new product launches that we've had. I think we as a pharmaceutical company are in a very unique position because our objective is to treat patients no matter where they are. And, we don't really see from a ground, on the ground standpoint, the impact on geopolitics. We're in a very strong position, as I mentioned, commercially, but that also gives us the opportunity to leverage into the innovation that is coming out of China. For example, the license agreement that you saw today. So, our objective remains very clear, which is to focus on innovation, regardless of where that comes from, and to serve patients, again, regardless of where they are on the planet.
Aran Nasaran, AstraZeneca CFO, really appreciate the time. Thank you very much indeed for joining us. Stock up today, as I say, driving the FTSE 100. Coming up, WeWork's downfall, potentially a windfall for its rivals. We are going to ask one. Jamie Hodari, co-founder and CEO of Industrious, joining us next to talk CRE, to talk the fallout from WeWork. That's next. This is Bloomberg.
The vast majority of the companies are well placed in terms of capital position. I'm not so concerned at this stage about the private sector. There are, and if you want to look at major events, right, black swan events or things that can really go wrong, history tells us that they usually come from government or real estate. So I think that while we look at the private sector, I think that the reality is that the most fragile part of the equation, if I look at the real estate, commercial real estate markets across the world, the post-COVID positive momentum was very short. So, and now the reality is that we see that COVID has changed the way people work, people use offices, and we see as we speak that that one has to be watched carefully.
That was UBS CEO Sergio Armati weighing in on the commercial real estate market from the Bloomberg New Economy Forum earlier today. So perfect segue to talk to someone now who's in the CRE trenches. It's time now for Wall Street Beat. We cover everything that's buzzing on Wall Street and the world of banking and finance. So this time we're going to take a look at WeWork Day 3 and its bankruptcy and its potential to hit other players in this space. Bloomberg's Shalini Basak joins us, along with Jamie Hodari, co-founder of Industrious, a WeWork rival. Jamie, great to see you.
Thanks for having me back.
Okay, so WeWork finally went bankrupt this week. Okay, and what does this mean for you?
For us, many of their spaces are going to end up closing as a result, and us and other competitors will probably take over some of them. There's going to be customers that move to other providers. But in general, I think that this is potentially going to present the sort of dividing line between V1 of our industry, this is maybe the death knell of that, and the next generation of where flex office is going, which I think is actually very exciting and one of the real bright spots within an otherwise troubled commercial real estate market.
There's a lot of people that are kind of calling doomsday on the commercial real estate market with the scale of which WeWork is exiting locations. 40 in New York, they have almost 800 leases in many locations in big cities. Do you think that this signals disaster, or are there ways for the industry to maneuver this, the commercial real estate industry in particular?
I think a lot of the stuff around, this is going to be apocalyptic for the real estate industry is overblown. The reason is, and I'll come back to this hopefully throughout the conversation, our industry is a lot like the hotel industry. So when a Marriott decides to close, it usually becomes a Hyatt or it becomes a Westin. You don't have a building that then sits empty for years. And most of these WeWork spaces are simply going to become an Industrious or an IWG or will be run directly by the landlord. They're not going to actually sit empty the way a lot of the press has described it. Other than the ultra large ones where they took down a whole building, those will probably shrink by about half.
Jamie, I would have thought, good morning by the way, that this would be the perfect time for your industry. Everybody's talking about hot desking. Everybody's talking about working from home, coming in a few days, the flexible approach. How did we find ourselves in a situation where the stock that's emblematic of this industry fails, yet the wind is blowing in the right direction?
That is the great irony of this moment. I think it is the big question, because this is the moment of greatest demand for flex. To your point, the way people work now, a lot of the workplace strategies that companies are deploying require them to work with a flex provider. And most flex providers are in their period of peak demand. So our revenue is up 40% this year. It's up 300% since 2019. And that's, that might be extreme within our industry, but most providers have seen some kind of increase in demand within that range. What happened with WeWork is two things. One, to go back to the hotel industry used to be run on leases. This is many years ago, and it was carnage. So most hotels, when they, someone would go lease a hotel, lease a building, create a hotel, they do well in good times, and they'd all go bankrupt in bad times. And about 30 years ago, hotels moved to management agreements, where it's run on a management agreement with the building, and the hotel industry has become much more stable, much more valuable. Our industry has undergone that same shift. So Industrious, for example, only does management agreements. WeWork is one of the legacy providers that was entirely based on leases, and that structure, that boom and bust business model, put them in a very precarious position. And I would finish by saying an easy way to think about it is WeWork's liabilities, just their fixed liabilities, their rent plus interest, was 85% of their revenue last quarter. There's no business on earth. There's no viewer that could imagine a company where 85% of their revenue goes to fixed expenses before you even need to run your company that would be able to survive. So that's what took them down.
What does this mean for the lessons learned? If you think about it, Industrious was actually formed around the same time as WeWork, and you only have less than 200 office spaces while they had almost 800. Was this the rate of growth? Was it the long-term leases? Ultimately, what are some of the big things that you've taken from this experience that you would do differently now?
There were moments growing at a more moderate pace where I felt anxious about it. I felt like, are we making the wrong decision? I do think it's helped validate that, a nice compounded 30, 40% a year growth is a more sustainable way to run a business than trying to triple in size every year. And I think it is part of the lesson is about that lease-based model, that basically they signed a lot of leases at the top of the market, and that's very unforgiving. So in general, I take away from it, this is a sector with a lot of demand, but you got to be thoughtful about your pathway for growth, and you have to have business models that are meant to profit and be sustainable, not to jack up revenue in the short run and sort of put down to tomorrow, well, we'll figure out how to be profitable tomorrow.
Jamie, can you just talk me through what you see actually happening in this space going forward from here, what the actual demands are? A lot of people are still trying to figure out their work life, trying to understand what their jobs are going to look like going forward. What do you see happening? We're seeing a lot of hot desking now. We're seeing, obviously, a lot of flexibility. We're seeing a lot of working from home. How do you see this process shaking out, settling down?
What I see, I think in Asia, employers will mostly ask employees to come back to work 5 days a week. In Europe, it'll be a mix. And in the US, most employers will allow employees to choose what to do. That's going to lead to or continue to accelerate this trend towards more distributed ways of working, where instead of saying we have 5,000 employees and they all have to live in Chicago or you better work somewhere else, they're going to have 200 employees in Denver, 80 employees in Miami, maybe a little cluster of 6 employees in Boise, Idaho. And so you'll see these networks of workplaces that companies use, and they're going to let employees come in a couple days a week if they want to come in, 5 days a week if they want to come in. But I think employees have loved that kind of freedom, and there's no evidence that it's been counter to productivity, so I expect that trend to keep going.
Jamie, really only 30 seconds left here. Do you think that leases are going to still come down meaningfully? I know you didn't see a catastrophic CRE impact, but what is the impact?
I think that long-term leasing is in trouble. Demand, depending on how you define it, is down about 50%. I think flex office is one of the sort of bright spots within that, but we're not big enough. We're 2-3% of commercial real estate. We're not big enough, with or without WeWork, to materially change that trajectory. So I do think overall it's a challenging period for office, but perhaps a bright one for flex office, and you'll see it grow from 2 or 3% of overall office to something like 10%.
So ironic. Jamie, great to see you. Thanks for stopping by.
Thank you.
Jamie Hidari of Industrious. And of course, our thanks to Bloomberg Shinoli Basak. Okay, coming up on the European close, Henrik Andersen, the Vestas Wind Systems president and CEO, will be our guest. We've just seen some news coming out relating to Siemens Energy. The German government looks like it is going to provide guarantees. How does that change the landscape for Henrik? We will find out in the next hour. The close is next. This is Bloomberg.